Today I would like to talk to you about accounting changes due to various items such as accounting principle, accounting estimate, reporting entity, and then we also discussed in very short way errors. So let's take a look at the very first one in the accounting principle. Accounting principle is going from one GAAP approved or allowed method to another GAAP method. If you're trying to add something new, it's actually not a change. It's not considered to be a change. So, for example, you've got intangible assets and you have not had them before, and now you need a new method to account for those intangible methods. That's new, so you're not changing anything. And also, please be aware that going from a non-GAAP to a GAAP method is not constitute an accounting principle. That is actually will have to be done as an error. So, for example, if a company that is required to use accrual method due to GAAP, maybe a publicly traded company, but they have been using cash basis of accounting, cash basis is not allowed under GAAP. So you're going from cash to accrual, meaning from non-GAAP approved to GAAP approved. That is not a change in accounting principle. That should be counted as an error. So I've repeated it a couple of times because you will see it constantly in exercises and problems. So some of the examples will be going from a LIFO method to an average cost, accounting for inventory, or from average to FIFO, or from LIFO to FIFO, from a percentage of completion method to completed contract method when you account for revenues. And what do we do in this case? The treatment will be if you have a direct effect, so inventories per se, they directly affect your net income. We will go retrospectively, and I'll explain in a second what it is. And if you have indirect effect, for example, your bonuses could be tied to net income. We cannot go retrospectively and go back and recalculate the bonuses because now net income changed. It will not be practical. It's one thing to try to mail the checks and additional checks, but what if now net income went down and now bonuses under the new method should have been lower? So we're not going to collect back some bonus that we paid out 2 or 3 years ago. So we will go currently from current year when the effect took change and on. Okay, so again, what does it mean retrospectively? So here is the little explanation here. You will have to change financial statements in all prior period presented. So as if you've used that method all along. You'll have to disclose in the year of the change the effect on net income and earnings per share in all prior periods presented. So your current year financial statements will be quite lengthy because you'll have to explain the change, the cumulative change in net income and earnings per share. And then you will have to report an adjustment to the beginning retained earning balance. Of course, they will be changed because prior years changed in the retained earnings statement in the earliest year presented. Okay, and we'll see through exercises as well. There's only one slight exception to this rule, and one exception will be when you're changing from any method of inventory to LIFO. Okay, so for example, when you're going from FIFO to LIFO, so you used to account first in, first out. So maybe you started your company in 50s, so you bought inventory at 50 cents first in, and then you can count it as first out. That is already sold. And now in year 2020, you decided to go to LIFO. So that's last in, first out. So I know I bought my inventory at $2 in 2020. So I will consider that $2 inventory that I just bought last as sold. Well, what should be shown up as inventory in the balance sheet? The very first layer from 50s. Well, there is a very good chance I don't have those records anymore. So if those considered to be sold under FIFO in 50s, we got rid of records. That's all gone. So there's not much we can do about it, okay? So because it isn't practical to go to LIFO and restate retrospectively, FASB says, okay, do not change prior year's income. Okay? Use opening inventory in the year the method was adopted as your base year inventory for all subsequent LIFO computations. Okay? Disclose the effect of the change in the current year and the reasons for omitting the computation of your cumulative effect and pro forma amounts for prior years. So basically, you will have to go currently and on. So you will not be able to restate prior years. It will just all take effect in the current year, and then you will be moving on forward. Okay, how about accounting change in accounting estimate? What are those? Those will result from new information. So, for example, change in salvage value or useful life of assets, or maybe change in uncollectible receivables, how much you're estimating. Maybe it used to be 5%, now it's 7%. Or change in inventory obsolescence. It used to be $10,000, now it's $15,000. Or change in liabilities for warranty cost and income taxes. How do we account for those? The treatment will be currently and prospectively. Or sometimes you will just see in the books it will say currently only or only prospectively. Counted as the same thing, okay? What you will not do is retrospectively. You will not go retro prior years, okay? So what does it mean? You will report current and future financial statements on the new basis. So if you decide to change the estimate in the year 2020, then financial statements 2020 will have that new information already, and then 21, 22, and etc. Presenting prior period financial statements as previously reported. So again, no retro change. And then making no adjustments to current period opening balances for effects in prior years because nothing changed in prior years. Okay. What if, okay, you have a change in both? When you have a change in accounting principle or method, and it will lead to change in accounting estimate. What the heck is this? Well, if you change a depreciation method, for example, you're going from straight line to double declining, that is considered to be a change in principle because you're changing methods. But because you did that, your estimates for depreciation expense will also change. So now we're talking accounting estimates. Oops. What about change in estimating receivables? If you go from percentage of sales to percentage of receivables, again, these are two different principles or methods. So we're talking the first one. But because of that, your estimate for bad debt expense or the allowance will be different. Now what are we going to do? We have both. And then FASB says if you have both, okay, you will have to lean it towards a change in accounting estimate, and you will do it current year and prospectively only. Okay, so again, no resetting prior years. So if you have both, change in depreciation methods, you will see that a lot. You will see change in receivables, percentage of sales, or percentage of receivables a lot as well. So remember, those are both, and that is considered to be an accounting estimate, and it will be currently and on. How about next one? You don't see this one a whole lot in our books. Accounting change in the reporting entity. So we're going from one type of entity to another type of entity. Some of the examples will be if you have statements of individual companies and now you need to consolidate, or you have specific subsidiaries that constitute the group of companies that are consolidated, or maybe you change in the cost to equity or consolidation methods. So what do we do with those? You will have to go retrospectively. So go back, okay, just like we did a change in accounting principle, the very first one. So what does it mean again? Restate financial statements in all prior period presented, as if we always combined those and individual companies, for example. Disclose in the year of change the effect on net income and earnings per share for all prior periods presented. So there will be a lot of disclosures. Okay, one more last one. That's kind of its own ballgame. Accounting change due to errors. And errors will happen if you go from non-GAAP to GAAP method. Okay, one of them that is quite popular, shows up a lot if you go from something that is not GAAP allowed, such as cash basis of accounting, into GAAP allowed, such as accrual basis. What do we do in this case? Again, restatement. What's restatement? It's the same as a retroactive, basically. So what do? Correct all prior period statements presented. Didn't I just said that in the other one? Because again, it's retrospective. It's the same thing, even though they call it restatement. And then we're going to restate the beginning balance and retained earnings for the first period presented, when the error occurred, and in the period prior to the first year presented. Okay. We do have, and just in general, we do have two types of errors, and how we correct them will be different for both types. The first type is counterbalancing errors. What does it mean? Those errors will self-correct in 2 years. So even if we do nothing and we leave it alone, in 2 years it will self-correct. Okay, I will tape another video to show examples of some of self-corrections. The first one is accruals. Okay, so for example, you forgot to accrue salaries at the end of 1 year. In the next year, it will self-correct. Or purchases in inventory or ending inventory. So inventory errors will be counterbalancing errors that will self-correct. And then non-counterbalancing, those will not self-correct. Okay, for example, depreciation. You might have miscalculated depreciation. Okay, or you expense depreciable assets. So instead of capitalizing it, you went ahead and expensed it in the first year. Or you expense land. Okay, brand new accountant. Or you record discount on a bond as interest expense. So those are not self-correcting. They will be lasting for several years, for example, depreciation, until your asset is off the books. Okay, or until your bond is off the books. Okay, and what do you do as far as disclosures for retroactive or restatement treatment? Okay, that's extra disclosures, nature and the reason why change occurred. So you got to explain your users what is going on here, why the numbers are different, especially if they looked at prior years and now retained earnings are different, so we don't confuse the user. The method of applying the change. Description, prior information, the effect of change on the income from continuing operations, net income, and then for any prior periods that were adjusted. And then the cumulative effect of change on retained earnings and other components of equity or net assets. Net assets is for non-for-profits in the statement of financial position at the beginning of the earliest year that we're presenting. That's it, guys. Thanks for listening.